stop what you're doing right now. I mean it. Close the other tabs, turn off the noise. Because what happened in the last 72 hours is not a market correction. It's not volatility. It's not even a crash. It's a coordinated strike that proves the battle for silver just ended before the West even knew it started. And if you don't understand what I'm about to show you in the next 15 minutes, you're going to watch the 50-nation cartel announced on Wednesday fail in real time while China walks away with control of the entire physical supply. Ladies and gentlemen, Asian Guy here. Today is Friday, February 6th, 2026. Silver is trading at $76.64 bid. Gold is at $4,959.30. Thursday, silver crashed from $89 to $63.90, 16% in one session. Today it recovered. Everyone is calling it a bear trap. They're wrong. It's an ambush, and while you were watching the price, China drained 18 tons of silver from Shanghai vaults in 72 hours. That's 580,000 ounces removed in 3 days. That's not profit-taking. That's a raid. Wednesday, the United States stood with 50 nations and announced a minerals cartel, strategic reserves, coordinated buying, finally a plan to break China's refining monopoly. Markets cheered. 24 hours later, silver crashed. Today, while the price rebounds and analysts debate support levels, physical metal is vanishing at the fastest rate we've tracked all year. This is not about the price you see on your screen. This is about the metal you can't buy at any price. And the trap was set weeks before Wednesday's announcement was even made. Let me show you the proof. This is the Asian Guy. In the next 15 minutes, I'm going to show you why that crash wasn't a failure of the cartel strategy. It was proof the cartel walked into an ambush. I'm going to show you the 3 indicators that reveal China knew this announcement was coming weeks ago. And I'm going to show you why the price action over the last 72 hours guarantees the cartel fails before it even begins. Subscribe right now because what I'm about to show you means the gap between paper silver and physical silver is about to explode wider than anything we've seen in modern commodity history. 3 days ago, the United States hosted a minerals summit, 50 nations, one goal: break China's monopoly on critical metals refining. They announced strategic reserves, coordinated purchasing, supply chain diversification. The financial media celebrated, finally, a unified Western response. Finally, supply security. I watched that announcement live. I read every line of the framework document. But while everyone was applauding the plan, I was tracking what happened immediately after. Because in resource warfare, execution matters more than announcements. And what happened in the 72 hours after that meeting proves China was ready. They didn't react. They activated. Hit that like button if you understand that watching what happens after the press conference matters more than what's said during it. Now let me show you what China did while the world was celebrating America's plan. The first move happened before most people even read the full announcement. Shanghai Futures Exchange vault data. Between Wednesday morning and Friday close, withdrawals accelerated to 18 tons of silver. That's 580,000 ounces removed from registered vaults in 3 days. For perspective, that withdrawal rate is the fastest we've tracked all year. Not the largest total volume, but the fastest rate per day. The timing is what matters. The U.S. announces a buying cartel designed to secure future supply. Within hours, China starts draining current supply from the only transparent vault system they still allow Western visibility into. And that's not coincidence, that's coordination. The second move came Thursday night, and most analysts missed it completely. China's export approval process for refined silver, which has been slow since January 1st, effectively stopped. Multiple refining sources are reporting that shipments requiring Ministry of Commerce approval are now facing indefinite delays. Before Wednesday's summit, approvals took 3 to 4 weeks. After the summit, approvals have stalled entirely. What changed? The 50-nation announcement included language about diversifying refining capacity outside China. China's response: tighten the current refining bottleneck before alternative capacity even exists. They're not blocking exports officially. They're making the approval process so slow that it functions as a freeze. This is strategic restriction. No sanctions, no headlines. Just enforcement delays that reduce Western access without triggering a diplomatic crisis. The third move is the one that changes everything. Market intelligence indicates China's state-directed silver purchasing program just doubled, from 500 tons per month to 1,000 tons per month. That's 32 million ounces entering Chinese reserves every 30 days. To put that in context, global mining production is approximately 1 billion ounces per year. China just committed to buying 8% of the planet's annual supply every single month. Not through open market purchases that would spike prices, through bilateral agreements with producing nations, off-exchange transactions, and state-owned enterprise inventory builds. The 50-nation cartel announced they plan to build strategic reserves. China responded by doubling the reserves they've been building quietly for the last 18 months. 3 moves, 72 hours, vault acceleration, export strangulation, reserve multiplication. This wasn't improvisation. This was activation of a pre-positioned strategy. Now, let me show you why the price crash on Thursday proves China's strategy is working, not failing. Everyone saw silver drop from $89 to $63.90 on Thursday, a 16% intraday collapse. Today, Friday, it recovered back to 76. The headlines called it panic selling, profit-taking market correction. They're missing what actually happened. Look at the COMEX data. On Thursday, February 5th, silver opened at 87.65. By end of day, it closed at 76.71. The range, 89.83 high, 70.17 low. That's a $19 swing in one session. Today, February 6th, it opened at 66.88, hit a low of 63.90 in early trading, and by midday, recovered back to 76.45. What does that tell you? It tells you the paper market is in chaos. It tells you automated sell stops triggered cascading liquidations. It tells you leverage got flushed, but here's what it doesn't tell you. It doesn't tell you physical demand disappeared. It doesn't tell you Chinese buying stopped. It doesn't tell you vault withdrawals reversed. The paper price crashed Thursday. The physical market didn't. Let me show you the proof. During the exact hours silver was collapsing on COMEX Thursday, premiums on physical silver in Asian markets held firm. 1 kilogram bars in Singapore, which normally trade at 3 to 5% over spot, were trading at 12 to 15% over spot during the crash. Today, Friday, even as paper recovered to 76, those premiums are still at 10 to 12%. Why? Because while paper sellers were panicking Thursday, physical buyers were absorbing everything available. That spread, paper crashing while physical premiums surge, that's the signature of a market where price discovery is broken. And broken price discovery is exactly what China needs to execute the next phase. Because if Western nations are trying to build reserves by buying silver at COMEX prices, but physical silver is only available at 15% premiums in Asia, who controls the actual supply? China does. They're bidding for physical metal at prices that make paper prices irrelevant. Now let me show you why China knew the 50-nation announcement was coming weeks before it happened. The evidence is in the positioning. Go back to January 30th. That's the day COMEX silver hit 115.85, the highest level in over a decade. 24 hours later, it crashed to 78.53, a 32% drop in one day. Everyone called it a bubble pop. I called it strategic selling, because that crash happened 2 days before the Minerals Summit even started. If you're China and you know a major Western buying announcement is coming, what do? You crash the paper price first. You flush out the speculators. You trigger margin calls. You create fear. Then, when the actual announcement happens and everyone expects the market to rally, you crash it again. Double shock, maximum panic, minimum resistance when you start draining physical supply. That's exactly what we saw. January 30th, first crash. Thursday, February 5th, second crash. Both timed around the 50-nation summit. That's not market volatility, that's tactical pricing. Look at the vault data in reverse. In the 2 weeks before the Minerals Summit, Shanghai Futures Exchange, silver inventories were stable. Around 220 tons registered, no major movements. Then, the week of the summit, 18 tons withdrawn in 3 days. If China was reacting to the announcement, you'd see gradual acceleration after the news. Instead, you see a sudden spike starting the day the summit began. That means the withdrawal orders were pre-authorized, the buying programs were pre-funded, the export restrictions were pre-drafted. All they needed was the trigger. The 50-nation announcement was the trigger. China didn't scramble to respond. They executed a plan that was ready and waiting. Now, let me show you why the 50-nation strategy is obsolete before it starts. The cartel depends on 3 assumptions. First assumption, there's time to build alternative infrastructure. The Minerals Framework announced Wednesday includes funding for new refining capacity in Mexico, Poland, and Australia. Target timeline, 5 to 7 years to bring new refineries online. China's response, act immediately to corner supply before those refineries exist. Even if the West successfully builds 100 million ounces of new refining capacity by 2031, China will have accumulated 2.5 billion ounces by then. The West will have infrastructure. China will have inventory. In commodity warfare, inventory beats infrastructure. Second assumption, 50 nations can coordinate without defection. The framework depends on every signatory nation acting in unified discipline. No side deals, no exceptions, no bilateral agreements that undercut the group. China's response, make defection profitable. If China offers to buy a nation's entire silver production at 20% over market, locked in for 5 years, how many of those 50 nations say no? We're already seeing cracks. Pakistan signed a bilateral minerals agreement with China in December. Brazil finalized a rare earth and silver cooperation deal in January. Both nations are signatories to the 50-nation framework announced Wednesday. The cartel hasn't even started buying, and members are already cutting side deals with the country they're supposed to be countering. That's not coordination. That's fragmentation waiting to happen. Third assumption. Western miners will increase production to feed new refineries. The 50-nation plan assumes mining companies will invest in expanded production because demand is guaranteed. China's response: destroy mining economics through price volatility. Look at what just happened. Silver hit $115 on January 30th. Miners looking at that price start planning expansion projects. By February 1st, silver is at $78. Projects that penciled at $115 don't work at $78. By February 6th, silver is at $76. Mining companies can't get financing for projects when prices swing 40% in a week. That volatility isn't natural, it's engineered. China can afford to buy physical at $120, while simultaneously crashing paper to $75. Western miners looking at $75 spot prices can't raise capital. The mining investment the cartel needs to succeed, China can prevent it by controlling paper price chaos. Let me show you the math that proves the cartel is already losing. Current state, February 6, 2026. China controls approximately 65% of global silver refining capacity. That's 650 million ounces per year out of 1 billion total. The West controls 350 million ounces. China holds an estimated 30% of above-ground silver reserves through state and state-connected entities. The 50-nation plan: build 100 million ounces of new refining capacity by 2031. Best-case scenario, that reduces China's refining share from 65% to 55%. But during those 5 years, China is buying 1,000 tons per month, 12,000 tons per year. That's 384 million ounces annually. Over 5 years, 1.92 billion ounces accumulated. Even if the West successfully builds new refineries, China's reserve position will have grown from 30% to 45% of global above-ground supply. Scenario 1, the 50-nation plan succeeds perfectly. By 2031, the West has 100 million ounces of new refining capacity. Total Western refining is now 450 million ounces per year. China's refining share drops to 55%, but China's reserve share has increased to 45%. The West won the refining battle. China won the inventory war. Scenario 2, the 50-nation plan hits delays, regulatory obstacles, cost overruns, permitting fights. By 2031, only 40 million ounces of new capacity comes online instead of 100 million. China maintains 60% refining control and holds 48% of reserves. The gap gets worse, not better. In both scenarios, China comes out ahead because they're not trying to maintain refining dominance forever. They're trying to accumulate enough physical silver that refining becomes irrelevant. If you own half the above-ground supply, you don't need to control processing. You control availability. Now, let me show you what this means for anyone holding silver, trading silver futures, or trying to execute the strategy the 50 nations just announced. The cartel was designed to do 3 things: stabilize prices, secure supply, prevent manipulations. China's response in the last 72 hours makes all 3 impossible. Price stabilization requires market makers with enough inventory to absorb shocks. But if China is pulling inventory off exchanges and locking it in state reserves, there's no buffer. Less available inventory means more volatility, not less. The 50-nation framework includes language about anti-dumping provisions and price floors, completely meaningless if the physical market disconnects from paper entirely. You can't stabilize a price that exists in 2 different realities. Supply security requires access to refined metal at predictable prices. But if China controls 65% of refining and is now restricting export approvals, Western buyers don't have access. They have a waiting list. The 50-nation cartel can announce coordinated buying all they want. If Chinese refineries won't ship, there's nothing to buy. And even if shipments resume, they'll resume at prices China sets, not prices COMEX quotes. Preventing manipulation requires transparent markets where price discovery reflects supply and demand. But we just watched silver crash 16% in hours while physical premiums stayed elevated. That's not price discovery. That's paper dislocation. The more China drains physical supply, the more the paper market becomes a side bet disconnected from reality. Eventually, one of 2 things happens. Either COMEX defaults because they can't deliver physical against contracts, or COMEX becomes irrelevant because everyone starts trading physical at whatever price China will sell at. Either outcome means the 50-nation cartel doesn't control silver prices. China does. Let me show you the historical precedent that proves this pattern repeats. We've seen this exact playbook twice in the last 15 years. Different commodities, same strategy, same outcome. Rare earth elements, 2010. The US realizes China controls 90% of rare earth production. announces a strategy to diversify supply, builds domestic processing plants, funds alternative sources. China's response immediately cuts export quotas, creates artificial shortage, prices spike tenfold. Outcome? 15 years later, China still controls 85% of rare earth supply. U.S. strategy failed, nothing fundamentally changed. Gallium and germanium, 2023. The U.S. announces semiconductor independence through the CHIPS Act, plans for domestic production of critical inputs. China's response? Export restrictions on gallium and germanium, which are essential for advanced chips. 98% of global supply. Outcome? U.S. companies still dependent, paid 400% premiums. Domestic production still not economically viable. Now silver, 2026. The U.S. announces a 50-nation minerals cartel, coordinated buying, strategic reserves, supply diversification. China's response? Accelerate vault draining, tighten export enforcement, double reserve accumulation. Outcome? To be determined, but history says the same pattern. Here's what the pattern tells us. Step 1. The West announces long-term infrastructure strategy. Step 2. China uses current dominance to make that strategy harder to execute. Step 3. By the time Western infrastructure is ready, China has locked up enough supply that the infrastructure doesn't matter. Step 4. Western strategy fails, China maintains control. We are currently in Step 2. The vault draining, export tightening, reserve doubling. That's China using their current 65% refining control to ensure the West never catches up. And the math says it's working. Let me show you what the next 6 months look like if this pattern continues. Phase 1, February to April. Paper price volatility continues. COMEX swings between $70 and $110 as algorithmic trading and leverage create chaos. Physical premiums widen from 15% to 30% over paper. Asian buyers absorb supply. Western buyers chase price. Phase 2, May to July. One or more nations from the 50-member cartel break ranks and sign bilateral deals with China for guaranteed silver supply. Media calls it pragmatism. Reality, defection. Cartel unity fractures before it executes a single coordinated purchase. Phase 3, August to October. COMEX registered silver inventories drop below critical levels as more holders withdraw physical rather than trust paper settlement. Exchange implements delivery restrictions or force majeure clauses. Paper market credibility collapses. Phase 4, November to January 2027. Physical silver trades at persistent 50 to 70% premium over COMEX. 2-tier market is permanent. China sets physical price through bilateral agreements. COMEX becomes a speculative side market disconnected from actual metal. This isn't speculation. This is pattern recognition. Every move China has made in the last 72 hours accelerates this timeline. The faster they drain vaults, the sooner registered inventories hit critical levels. The tighter they make export approvals, the faster Western buyers get desperate and accept bilateral terms. The more they double reserve buying, the wider the gap between available supply and cartel demand. Speed beats strategy, and China is moving faster than the 50-nation cartel can coordinate. Now, let me show you why Wednesday's announcement was the best thing that could have happened for China. Before the Minerals Summit, China's silver accumulation was quiet. Bilateral deals, off-market purchases, gradual vault build. No attention, no resistance. After the Minerals Summit, the West just announced they're coming for the same supply China is accumulating. That announcement doesn't hurt China. It validates their strategy. Think about it. If 50 nations just declared silver is critical to national security, what does that do to the asset's strategic value? It confirms it. Every nation that signed that framework just admitted silver is essential. That admission makes China's accumulation more valuable, not less. Because now it's not just an industrial commodity, it's a geopolitical lever. The 50-nation cartel thinks they announced a defensive strategy to secure supply. What they actually did was announce to the world that silver is a choke point worth fighting over. And the country that controls the choke point just got more powerful. China doesn't need to defeat the cartel militarily or diplomatically. They just need to own enough silver that the cartel has to negotiate with them to access it. And based on the last 72 hours, that's exactly what they're doing. Vault draining, export tightening, reserve doubling. 3 moves that guarantee by the time the 50-nation cartel is ready to start buying, China already owns the supply they were planning to secure. Let me give you the only number that matters. 1,000 tons per month. That's China's new reserve buying rate according to market intelligence. 32 million ounces monthly. 384 million ounces annually. Global mining production is 1 billion ounces per year. China is now absorbing 38% of total annual mine supply just for state reserves. That doesn't include industrial demand. That doesn't include private investment. That's state accumulation alone. If that rate continues for 5 years, the length of time the West needs to build new refining capacity, China will control 1.9 billion ounces in state-connected reserves. At current market prices, that's $146 billion in strategic assets. But it's not about the dollar value. It's about the supply control. If you own 40% of available inventory, you don't just influence price. You set terms. You decide who gets access. You determine at what price and under what conditions supply becomes available. Now let me show you the industrial demand component that makes China's position even stronger. Silver isn't just a monetary metal, it's essential for solar panels, electronics, electric vehicles, and defense systems. China is the world's largest manufacturer in all four categories. When China buys 1,000 tons per month for strategic reserves, they're not just cornering financial supply. They're securing industrial feedstock for their own manufacturing base while denying it to competitors. The 50-nation cartel wants to build electric vehicle supply chains outside China. But if China controls the silver required for EV charging infrastructure, battery management systems, and power electronics, how do you build that supply chain? You can't. The West is trying to decouple manufacturing from China, while China is locking up the raw materials that manufacturing requires. Look at the solar sector specifically. Global solar panel production requires approximately 120 million ounces of silver annually. China manufactures 80% of the world's solar panels. That's 96 million ounces consumed by Chinese factories every year. If China is also buying 384 million ounces for reserves, their total annual silver absorption is 480 million ounces. That's 48% of global mine supply going into Chinese hands through just two channels: state reserves and solar manufacturing. The West's green energy transition, which the 50-nation framework explicitly mentions, depends on solar deployment. But solar deployment depends on silver. And silver supply is being systematically cornered by the country the West is trying to counter. That's not just a commodity squeeze. That's a technology choke point. Let me show you what happens when you layer military demand on top of industrial and reserve buying. Modern defense systems, missile guidance, radar, electronic warfare, all require silver for conductivity and reliability. The United States Department of Defense consumes an estimated 8 to 12 million ounces of silver annually across all programs. Not a huge number compared to industrial use, but it's non-negotiable demand. Military systems can't substitute inferior conductors. They need silver. If global supply tightens because China is absorbing half of annual production and physical premiums widen to 50% over paper, what happens to defense procurement costs? They double. The 50-nation cartel includes security language about protecting critical supply chains for national defense. But if the metal required for defense systems is trading at premiums controlled by the nation you're defending against, you don't have supply security, you have supply dependency. Now let me connect the final piece that shows why China's 72-hour response is a complete strategic framework, not just opportunistic buying. Currency warfare. The US dollar has been the global reserve currency for 80 years. That status depends on other nations holding dollars for trade settlement. But if China accumulates enough hard assets, silver, gold, rare earths, and offers to settle trade in yuan backed by commodity reserves, the dollar's reserve status erodes. The 50-nation framework announced Wednesday includes payment mechanisms denominated in dollars. China's response: buy commodities that hold value regardless of currency. If you're a producing nation looking at the next decade, do you want payment in dollars that might depreciate? Or do you want payment in yuan that China will exchange for guaranteed commodity purchases? We're already seeing this shift. Saudi Arabia accepting yuan for oil, Brazil and Argentina discussing yuan trade settlement. Now silver becomes another commodity where China can offer, sell to us in yuan. We guarantee purchase at premium prices, locked in for 5 years. That offer is more attractive than joining a 50-nation cartel that promises future coordination but delivers present uncertainty. This is multi-domain warfare. China isn't just buying silver to corner a commodity market. They're buying silver to secure industrial supply, deny competitor access, accumulate hard asset reserves, and create currency settlement alternatives. The 50-nation cartel is fighting on one domain, supply chain security. China is fighting on 4 domains simultaneously: industrial control, financial leverage, currency alternatives, and geopolitical positioning. That asymmetry is why the 72-hour response was so effective. The West announced a single strategy. China activated a multi-layer framework that was already prepared and positioned. The 50-nation cartel announced Wednesday believes they can build infrastructure and diversify supply sources. China's response? Own the supply before the infrastructure is ready. It's the difference between building a refinery and owning the ore. You can have all the processing capacity in the world. If there's no input material, the refinery sits empty. That's the trap. The West is building refineries. China is cornering feedstock. And the 72 hours after the Minerals Summit prove China is accelerating the corner. 48 hours ago, the United States announced the largest coordinated intervention in critical minerals in 50 years. 50 nations, strategic reserves, price protection, the entire financial world watching. Today, I showed you China's response. Vault withdrawals at record pace, export approvals frozen indefinitely, reserve buying doubled to 1,000 tons monthly, 3 moves, 72 hours, 0 public statements. While the West announced what they're going to do 5 years from now, China executed what they're doing today. This is not about supply chains. This is economic siege warfare, and the battle for silver just went from planning to execution. Share this with anyone who thinks the 50-nation cartel changes the game. They need to see what China is doing while everyone else is reading press releases. Drop a comment. Who controls the next phase? The 50-nation committee or China's command execution? This is the Asian guy. Track vaults, not votes. Right now, the vaults are emptying faster than any cartel can fill them. The West's strategy depends on 5 years to build capacity. China's counter-strategy is to own the metal before that capacity exists. Action beats announcements. Speed beats structure.